Watching today. I'm working more on my stock market project. It was a long day yesterday at work, so I didn't do a stream last night. But I fell asleep around 10:30, and then I woke up at 1:30. So I figure I'm not tired right now. I figure I'll work on this until I get tired. So before we get started, let me go over where I'm at, what I've done so far, and what I'm going to be working on today. So. Here's the general outline for the project. Right here, I have two goals. So my first goal is beat the S&P 500 by a significant margin and stay market neutral. So the S&P goes up on average 6% per year. I want to go up on average 3 to 4 times that, 18 to 24% per year. Sorry, I feel like I have to sneeze. I guess not. So that's my goal. 18 to 24% per year and stay market neutral. So if the S&P is going down or up, I don't really care. I should be getting this consistent return no matter what. So I'm writing all the code to do this in Python. I want to do this through an automated model. So basically I have something that spits out portfolio positions per day, how much to buy and sell. Everything should be automated. So I'm writing all of this code in Python. So my second goal for the model is to generalize this into a tool that anyone can use to create these sorts of models for themselves, make a useful strategy for themselves. So if you're interested in that, you can find the link to the GitHub repository in the description. This is the GitHub repository. So right now I have a successful model working, and so the universe and the model, the first two steps you see at the bottom, are defined in under 100 lines of code. If you're interested in using this, you can download it here. The link's in the description. You can fork it. If you find it useful, please star the repository, watch the repository, and follow me on GitHub. That stuff helps me out. So this is the outline for the model. So the first thing, I should say also a requirement I have for the second goal is everything should be free. So I found a really good data source. The link for that's in the description. I have instructions for installing it and getting it set up in your GitHub. The instructions are in the GitHub. So that free data source has data going back to 2011. You don't want to use all stocks though, so you don't want to use things like low volume stocks or penny stocks. And furthermore, I'm only using real estate investment trusts, ADRs, which are foreign companies listed on the US stock market, and common stocks like Apple or Tesla. So I got a stock universe that seems to work well for my model. Then I'm using that to train my model. And the returns model should be predicting something like returns relative to the market average, returns relative to the sector average, probability of a positive return. I'm predicting Sharpe ratios over the next 5 days, and I have a really good model, so I'll show that in a second and explain why I'm confident in it. And finally, the last step, now that I have a good working model for predicting things, predicting the Sharpe ratio, the final step is implement a portfolio model to allocate money based on the output of the returns model. Here's the model, and here's why I'm confident in it. So just a sec, let me pull it up. Yeah, this is the model right here. So why am I confident in it? First off, I'm looking at these metrics highlighted in red. So the first metric is the information coefficient. I'm shooting for 0.01 to 0.02. This is standard for the stock market because there's a really low signal to noise ratio. And so even though I'm shooting for 0.01 to 0.02, I'm getting 0.047, much higher than my goal. These next four metrics. So information coefficient is giving the predictive power of the model. How good is it at predicting? So you want something that has high predictive power, but you also want something that's stable. You don't want to have really bad predictions when it's wrong. You want it to be stable. So I'm looking at the stability of the model with the standard deviation of the information coefficient. I'm going for 3 to 13 times as my goal. This is about 3 times, so at the lower end of my range. For these other metrics, the information coefficient to information ratio, both on a daily and annual basis, On a daily basis, I'm going for 0.03, so I'm getting higher by an order of magnitude with this model. On an annual basis, I'm going for 0.3. Once again, it's higher by about an order of magnitude. And the T statistic, my goal is 1.98. So it's beating or at the metrics for all of, at my goals for all of these metrics. So for that reason, this looks really good. Now, this is for a single model, trained from 2011 to 2019, validated 2020 to 22. Validation basically means tuning the hyperparameters in the model. And then I'm testing it from mid-23 through the beginning of 26. So this is the decile analysis for the model. The hallmark of a good model when you look at the decile analysis is the bottom decile, bottom 10%, should be performing worst, and the top decile, top 10%, should be performing best. And in between, it should be monotonically increasing. So that means each decile is higher than the previous decile. And those characteristics are exactly what we see right here. So it looks good for this reason. Also, if I do a walk forward analysis, so instead of just one model, I train a new model every single year from 2016 through 2025. You see the information coefficient only falls below 0.02 in 2018, and it never falls below 0.01. So it's hitting my goal for every single year. Same thing with the information coefficient to information ratio on an annual basis. My goal is 0.3. It never even comes close to that. So it looks good for this reason. And finally, when I look at all of these models from the walk forward analysis, you see that it's not perfect, but it roughly shows the pattern I'm looking for. Top decile's highest, bottom decile's lowest. It's not always monotonically increasing, but it's pretty good. So for these reasons, I'm really confident in the model. So I'm looking at a portfolio strategy to implement the predictions from this model. That's turned out to be a bit of a strenuous effort. These are my initial attempts. I wasn't able to get anything good. And you see the problem is summarized here. So the portfolio strategies I was trying worked really well after 2023, but basically failed from 2016 through mid-2021. So these simple strategies weren't working, so I did hierarchical risk parity for the bet sizing. And that's what I have here. And so this obviously doesn't look very good either, but I saw that if I was changing around some parameters, I was able to get improvements. That's what I was working on yesterday morning. Rebalancing less often every 5 days versus every 1 day gave an improvement to the model. I also found that the fewer stocks I was putting into the model, the better it performed. I also found that if I incorporated hysteresis, so stopped stocks from dropping out, if they fell down out of, say, if I'm going the top 10 longs and top 10 shorts, if a stock fell out of the top 10, say it dropped down to 11, I'm still keeping it in the model. So buffer multiplier of 2 means I'm keeping it. If it didn't fall out of the top 20, buffer multiplier of 3 means I'm keeping it if it didn't fall out of the top 30. So I found that the buffer multiplier of 3 seemed to do better for the model. If I smoothed the predictions, so basically did an exponential moving average on the predictions, that improved the model. And finally, I found that the longer I'm looking back for the hierarchical risk parity bet sizing, the better it was performing. So all of this looked really good. And so I summarized that here, and then I implemented everything at once. This is the last thing I did on yesterday morning's stream. And you see, actually, this is the worst performance I was able to get out of anything. So today I'm looking into how can I, these variables are somehow tied to each other, but I'm not sure how. So I want to look into that. So, that's what I'm going to be working on today. If I could get something that looks okay, then I'm going to go ahead and incorporate some high-level strategies like scale down if there's a big drawdown, scale down if the volatility is high. So yeah, that's what I'm working on. So with 5-day window, how do other parameters affect HRP? And if you're watching, please recommend me some music. All right, so with 5-day window, how do other parameters affect HRP? So, let's do, instead of this, let's do 5 rebalance days, buffer multiplier of 3. Okay, so let me see actually first what were the best improvements. So, sorry, I'm kind of sick. So what gave the highest returns? Number of stocks seemed to perform best. So, 5-day rebalance, not window. So let's just do 5 longs, 5 shorts, holding period, 5 days. HRP look back, let's change this back to 60. Smooth predictions is false. Yeah, let's do false. Okay, so the best performance, how did the 5-day window or 5-day rebalance gave a pretty good performance increase. So let's look at 5-day rebalance and the number of holdings. Five-day rebalance, buffer multiplier should be 1. Smooth prediction should be false. HRP look back is 60. Holding period's 5. Okay, so what if we do this with 5 longs and 5 shorts? Portfolio Explorer. Let me make sure this is saved. So then I'm going to give this to the AI and say, what's up with this? Do I have Google AI Studio pulled up somewhere? Oh yeah, here it is. So the first screenshot shows my assessment of changing parameters in the model. So that looks pretty good. Still not good until 2020 really, but 5-day rebalance. I'm just gonna put in this value actually. Alright, so now let's try it with 10 longs, 10 shorts. How changing parameters in the model improved it. I changed each parameter individually. Not model, I'll say portfolio strategy. Improved results. I changed each parameter individually. to find what works well. Okay, here are the results using 10 longs and 10 shorts. So again, returns go pretty positive. But not as positive as last time. This guy's with 5 longs and shorts. Um, 0.35. So fewer longs and shorts, fewer positions basically increase the returns. All right, so let me put this in. I changed each parameter individually to find what works. Then I incorporated all params into the model. This which is in the second screenshot. Despite each param improving the model on its own, the model improving into this strategy. Despite each param improving the strategy on its own, I got the worst performance out of any strategy when I incorporated all at once. What could be the cause of this? Over. Didn't have to cut me off. All right, so 10 longs and 10 shorts improve it. So let's stick with 10 longs and 10 shorts. And now let's look at what if I add a hysteresis buffer. And I wouldn't get you hung up on somebody that you used to know. 10 longs and shorts. Buffer multiplier is 2. All right, let's run this guy. Nonlinear parameter interaction, obviously. In quant finance, combining 5 optimal parameters creates a bomb. Proof of bankruptcy, obviously. Wait. Drops to minus 182%. Oh, yeah, it does. All right. I mean, it seems like I kept taking short positions. So what do I conclude about this? So what if I increase it to 3? I don't need proof of bankruptcy, I'm well aware. Why did the improvements cause this? Individually, each parameter you changed added a specific type of friction or risk. When isolated, the baseline model could absorb that risk. High concentration, slow execution. Hysteresis of 3 means even if it finally realizes the short is going bad, the portfolio keeps shorting it anyway. Oh, okay. So here I still have the bad drawdown, but it starts performing better in recent times. Implement a max position cap. If you want to use n equals 5, you must constrain HRP. Never let a single short position. Beware of hysteresis. It is fatal for short positions. Okay, so here are the results. Yeah, so maybe I shouldn't look parameter by parameter. This is, I mean, it's going to turn into an optimization problem, but, if I went from first principles and got something that worked, I could be very confident in it. Without doing that, I can't be too confident. But let's see. So basically, I don't want smoothing and hysteresis. So what if I do the same thing, but only rebalance every day? Hmm. Portfolio. Yeah. Okay, let's see if this works. So what if I train it from 2016 through 2018? Hey, that looks not bad. So maybe I want to do a 1 day rebalance. This is probably not real. So drawdown of like 22%. Um, Something else to implement is scaling down by volatility of the individual stock. Um, doesn't look bad though. Hmm. Hey, Tusharand. Rebalance. If I started today from a software engineering background, what would your 6 month roadmap? I don't know because I don't do high frequency trading. I'm trying to do swing trading, but I would say just start building a model, and keep hitting your head against the wall, until you get something that works. And uh, I don't know if you're gonna do high frequency trading, the big thing is you're gonna have to be willing to pay for data. And I think it gets pretty expensive for high frequency. Like if you want minutes or second data, I don't know if they have second data. They have minute data though, and I know that gets expensive. If you want a good data source, the whole trouble is so you could use Yahoo Finance as your data source. Um, but they have a lot of drawbacks. Like they don't have. It's basically going to be hard to backtest your model with Yahoo Finance data. So you need a better data source. But yeah, so that's kind of the problem is your data source. But my roadmap would be just start building a model, make something that you think works, and just hit your head against the wall and go. If it's not working, why? Why? Improve. Improve every single day. That's kind of my philosophy. I think, you know, if I just keep improving this every single day, and even if I don't improve it on a day, if I spend a day kind of hitting my head against the wall and figure out, you should either improve it every day or figure out something that doesn't work every day and gain knowledge every day. And then, at some point at the end, you're going to look up and go, wow, I'm making money in the market. But high frequency trading's hard. You're at a huge disadvantage. You have to compete with all these firms. Like if you know Jim Simons and Renaissance Finance, um, they're really good. So, it's kind of going to be hard to do. Yeah, I mean, the people you're going to be competing against are, they have special fiber optic cables built, to scalp things in like seconds or even milliseconds. So if you're competing, personally, I think for me, I just think competing with those guys, I'm not going to be able to, but I can compete on with a swing trading strategy. Basically, with swing trading, you don't need to leverage the high data. If you're doing high frequency trading, you're gonna have to be really concerned about your data transfer rate. If you're doing swing trading, you can ignore the data transfer rate and just focus on having a better model. It's kind of a trade-off, but yeah. So I don't know. I'm scared of high frequency trading. So if we're testing the optimization, let's get the portfolio, and then let's say best params is equal to optimize HRP strategy. Optimize. And we're going to put in portfolio. We're going to put in train start. So let's start training 2016-01-01. Let's end training in, let's do mid 2018. Sure. Good luck. What's your software engineering experience? What languages are you good at? What do you do for work? Okay, so let's try optimizing. Test basic HRP optimization. Okay, so I'm going to turn this guy on. And AI is an unbelievable tool. No module named opt. What line? Line 11 from portfolio import opt. Oh, I didn't finish typing that. I already have Optuna. Okay, so let's try to do an optimization and see how that works. And then let's open another one. And I could keep trying different things. So 10 longs, 10 shorts with the buffer. And so buffer and smoothing are doing kind of the same thing. So what if I take out the buffer and just smooth it instead? So let's turn smooth predictions to on and change the buffer to 1. And we need to turn that back on instead of the optimization. Oh. Okay, so what's the objective function? I'm a Java backend developer working on scalable APIs, microservices, and database optimization. Lately, I've been looking into the transition more into AI and quant focused work. Oh, you're like me. You want to transition like me. Um, yeah, you have to. I think maybe the biggest hurdle for you to jump over if you don't have experience with models is just, yeah, working with models because it's kind of a different thing from most coding. I'm like the opposite. I have good experience with models and I'm not a great coder. I've never worked a coding job, so I'm like a self-taught coder. I do coding for work, but it's really just all model stuff. So um, we have opposite skill sets. I need to be better at coding. I don't know. Maybe you're good at visualizing kind of like abstract models if you're doing API stuff. But yeah. So what am I optimizing to? Um, But basically, look at this. I mean, I've been working on this since the beginning of the year. I'm up to almost 200 slides, and it's literally just going through things, changing things. Um, just hitting my head against the wall, trying to make it better. And I keep running into problems. Like I thought I had a good model. I was getting my universe wrong. I changed that. I tried incorporating sector data. That made the model worse. It made it better on my bad model, worse on my good model. So, um, so here's the changes. So daily rebalance with smoothing instead of hysteresis. I think the drawdown was better. Um, so let's put that into the PowerPoint. Don't wave no goodbyes. Okay. All right, so let's look again at the optimization function. So score is sharp times 1 plus max drawdown. So scaling the sharp down by whatever the worst drawdown is. So really, ideally, it would be above 1. What is a good goal for this objective function drawdown weighted sharp? My intuition is that it should be 1. Is this correct? So yeah, I mean you could ask it questions like this. You know, The AI has really helped me kind of develop a good understanding of this stuff. 0.17, so it hasn't improved since the second iteration. um, I mean, I'm not gonna want to hold it for 10 days. I can. Hmm. Oh, good. It found 0.5, so we're getting there. We're halfway there, and it's about a third of the way through the tuning. I'm new to coding and have developed a strong interest in it. Could you suggest if you're a beginner and you want to get good at coding, you just need a project. And it should be something you're interested in, so you want to keep working on it through to completion. So that's kind of the hard thing. Uh, is there anything you're interested in? And yeah, I could suggest some projects, but really the key is you have to find it interesting and be willing to work on it a lot. But with AI, you can really get good at coding quick. It's basically like your tutor. So um, it'll help you with coding. It'll help you with understanding the project and your goals. So yeah, I think that's the way to go. So we're getting 0.5 in sample. So hopefully I'll get above 1 for the in sample tuning. Okay, so now I need to incorporate some high level strategies. Is it worth scaling down the position determined from HRP is it worth scaling it down by according to the volatility of an individual stock? Yeah, so there's 9 people watching, so I'll take this opportunity quickly to say please subscribe, like the stream, check out the GitHub. You can do everything I'm doing. I have this really good model here. You can get the model for yourself. You can, generate this model. I've defined a universe and created a model in under 100 lines of code. So you could do the same thing if you use the GitHub tool that I've made. The repository links in the description. If you find it useful, please star the repository, watch the repository, and follow me on GitHub. That stuff helps me out a lot. All right, so, oh, don't do this. HRP weights it by stock. Well, I'll tell you is a trap. Doing so will break the mathematical foundation. HRP already does this. The danger of double counting. If you manually scale down HRP weights by individual volatility, you will accidentally destroy your diversification. Obviously, it will hyper concentrate in low volatility stocks. Portfolio level volatility targeting instead of the individual stocks. Yeah. Signal volatility, prediction volatility. Um, is it better to scale the model, scale the portfolio, capital allocation by volatility of the portfolio or volatility of the market, VIX? So still at 0.5, we're about halfway done with the optimization. So not great, but not bad. I mean, if I get something that's positive 2016 to 18, obviously it will be positive. If I'm getting that for the drawdown sharp, it should be stable though. Yeah, I need to think about this. For market neutral, it's almost always to scale your capital. Oh, based on portfolio volatility. So VIX is a trap. That's what I was doing before. It also seems to be worthwhile to scale down the capital allocation based on the drawdown if the portfolio strategy goes negative for some time, some space time, I want to scale down the capital allocation as well. What is the best practice for this? Used by quant investors. And is it reasonable to use this in conjunction with a volatility risk scaling? Are there any other allocation scaling techniques which are common? Think from first principles and use best practices. All right, how's this guy doing? Still at 0.5 or at 62%, so I might not be able to improve past 0.5, but we'll see. Results from optimizing portfolio parameters from 1/1/2016 to 6/1/2018. Still not improving. Your intuition is blah 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 blah. Applying it requires navigating a dangerous mathematical paradox. Yep, I'll kill my returns. Drawdown paradox. From first principles, the purpose of drawdown scaling is survival. Yeah, I know about that. Best practice, do not scale down linearly. Instead, use a step function or circuit breaker approach. Combining drawdown control with volatility scaling. Yes, it is highly reasonable to combine them, but you must avoid double punishment. They're correlated. Okay, yeah. Kelly-based scaling. Beyond volatility and drawdowns, institutional quants use a few other. Instead of looking at past returns, you look at predictions. If your model's predictions for the top 20 stocks are highly confident, and you scale gross exposure up to 100. If the model's predictions are all clustered near 0, you scale down. Market dispersion scaling. A long-short market neutral strategy makes money entirely on the spread. Portfolio volatility targeting. Scale dynamically to keep portfolio at 10%. Okay, so implement a method called set scaling params, which allows me to implement these scaling parameters into my HRP backtest strategy. Then tell me where and how to update the rest of the code in order to incorporate this correctly. Whoa, good, we found a better value, but I didn't find a better value till it's 78% of the way done. So I'm only doing 50 trials. I might want to do more trials, but we're not too far from being done. We have 9 trials left. So once this finishes, I'm going to see how does this strategy run. Obviously, it should be good 2016 to mid-2018. The real question, is it good from mid-2018 through 2021, really? And then it should, I'm not having too much trouble doing well after 2023. So if this, obviously it will work well beginning of 2016 to mid 2018. If it's also working well, oh good, another slight improvement. If it's also working well mid 2018 through 2022, that's the big test. And the final test for what's it called? So I know I'm not going crazy, will be to, if it's doing well from mid 2023 onward, that's what I've been getting. So set scaling params. Okay, so that's the method. After plot, let's make this method. And then what do I want to change? Alright, so let's put this into run before the loop begins. And there's going to be something to change inside the loop as well. So optimal is 30 positions, 4 rebalance days. So close to 5. Holding period is 9. Interesting. HRP look back 30. Buffer multiplier 1. Smooth predictions is true. So I guess the holding period of 9 and the smoothing being on is helping me out. So okay, so now let's run it with these parameters. So 30 positions, long, short. Four rebalance days, holding period of 9. HRP look back should be 30, so it's at the minimum. So that's interesting. Holding period, we have buffer multiplier 1, smooth predictions true. Okay. Alright, so this is going to run those parameters. Let's see how it does. Our big test is mid-2018 through 2022. If it's performing well there, we know we're good. Then our sanity check is mid-23 through beginning of 26. It should still be performing well. Okay, so inside one right after step 1. So it was really optimized to this region. and it was just doing whatever to pick that big up, but then it did really poorly. Mid 2018, basically, yeah, it failed afterwards. Well, it's a result. All right, let's finish implementing this. So, right after step 1, total nav equals sum tranche days. Yep. Apply this scalar to the tranche budget. Budget. Designing a quantitative strategy from first principles means building Alright, so end positions 20 to 40. Let's just do 20. Holding and rebalancing. Holding period 5 days. Rebalance days 1. HRP look back 60. Hysteresis. Smoothing on. Alright, let's add some more rows. Alright, so target volatility, let's do 0.1. Volatility look back 20. Drawdown warning threshold minus 0.12. Drawdown penalty should be 0.5. DD kill switch 0.25. Conviction look back 20 days. All right. Test HRP test scaled HRP is equal to 1. And then we'll say if get the portfolio. I'll just change this and use the same. Holding period 5, rebalance 1, HRP look back 60, smooth predictions true, hysteresis buffer 1.5, target volatility 0.1, volatility look back 20, max volatility leverage. Volatility look back 20. Max volatility leverage 1. DD warning threshold 0.12, DD penalty 0.5, kill threshold okay 0.2, conviction look back 20. Alright, let's see how this works. Invalid value, okay. So something weird's gonna happen. I think it's probably gonna go to 0. So it's probably just gonna give me nothing. So what changed? That is exactly the same. Change it to this. And date and self.date groups. Tranche total value is tranche navs of tranche IDX. Budget equals total value times scalar. Yeah, so it just goes to 0. Okay, so I'm gonna troubleshoot this on the next stream. Later tonight or tomorrow. That's it for now. I'm getting tired. Thanks for watching. Have a good rest of your night or day, whatever time it is there. Adios. Have a good one. It just goes to 0.